This is NJ Thrive Small Business Webinars. Welcome everyone. We provide weekly webinars created to help New Jersey small business owners to start, grow, and thrive their businesses. This is brought to you by the Small Business Center of New Jersey. I'm your host, Marjorie Salas, and I am also an SBDC consultant. We are America's New Jersey's Small Business Development Center Network. We're a state program powered by the SBA and partners with small business to help in three major areas. We provide no-cost small business consulting. We also provide training and events at no cost. And we provide resources for small businesses as well. Please know that wherever you are within our state, there is a center near you where you can reach out and we will be there to help your small business. Today's agenda will be presented by Ryan Silvestre. Sorry. These are this week's headlines. Let me get rid of this. The applications are open for NJEDA Brownsfield Redevelopment Incentive Program. Also, as the SBA will be hosting their second annual Small Business Cyber Summit during Cybersecurity Awareness Month. Please know that the SBA EIDL, sorry for that, Disaster Declaration Interstate 95 Collapse Bridge. You can find all these resources in our website. Please keep in mind that you can type in all your questions in our Q&A box, not in the chat box. And also, please complete a 3-minute survey where we will send you, as soon as you complete the survey, we will send you the webinar resources, the presentation, and any other link that was part of the presentation. This is very important for us, so please complete this 3-minute survey. Today, we'll be presenting Ryan Silvestre. He is the captain for NJSBDC consultant teams on how to get funding for small businesses. Let's welcome Ryan Silvestre. Oh, if you have any questions, you can always scan the QR code. Hi, Ryan.
Hola, hola, hola. Haven't been called the captain yet, but I appreciate it, so saludos. Saludos,
there you
everyone.
go, Captain.
And welcome to Where Is My Money? That's the whole topic right here today. We're all looking for ways to grow our business. And I'll start just with a quick little 10-second introduction about who I am, just to kind of validate my words a little bit. So I've been working with businesses for the past almost 20 years, and it's always been the same job, which is how to get funding for your business. Even when I was in college, I was working for a local small business loan broker. And I can tell you with a lot of confidence, I have never come across a client that I can't get money for. Sometimes it's waiting a little bit, and putting things in order first to prepare for our funding, but that's what we're going to talk about. So let's share my screen and take a look at what we got to talk about today. Let's see. Okay, and slideshow begin. Perfect. Okay. And one of the things that I like to do during these workshops, just to kind of break them up a little bit, is every once in a while, we'll take a question or two, just if it feels like it's very important for the narrative of that moment. But for the most part, all the Q&A is going to be done at the end. So let's say 98, 99% of the questions, we'll have plenty of time to chat about it at the end of the presentation. But again, just if there's something very important, Marjorie, if you can, just feel the questions. If there's something from Marjorie, from your side, as an entrepreneur yourself, that you think is important that you might not know yourself, or you think it's important for people to know in general, then just jump in with and let me know that there is this important question, and we'll field it as they come. So how to get funding for your small business. Here we go. Let's see, is it spacebar? There you go, perfect. So here are some objectives of what's going to happen today and what some of the goals are. So the first part is how to prepare for the funding conversation. Like I mentioned, I've been doing this for almost 20 years now, and for the majority of the cases, the hiccup is actually at the preparation. So it's I don't have my documents prepared correctly, or my business is not in the right stage for the type of funding that I'm looking for at that time. And that's what I want to spend a little bit of time on today. So I would say maybe a good 60% of the presentation is how to prepare for that conversation. And then the other parts are going to be what story to tell in that, in your narrative, in your financials, in your documents, so that I can justify what the ask is, with what you're going to be receiving. So how to tell the story through documentation, that's very, very important because the business plan, the financials, they're all telling the same story. The only difference is that one tells it with words, the other one tells it with numbers. So we have to make sure that they're telling the same story. And that's another common ground where a lot of applications get, tripped up, because one side might say something a little bit different, and then the numbers don't back up what the initiative is. If I say I'm going to do this type of marketing, but my marketing budget on the financial side isn't heavy enough to justify this type of action, again, a big disconnect between the two. And how to think like an underwriter. So that's a major component of trying to get whatever the ask is. Now, not all underwriters think the same, because not all sources of funding is the same. We're going to talk about loans. We'll talk about grants for a little bit. But there is always a person that makes the decision, or sometimes a team of people that make the decision on whether the funding should be given to you or not. So we need to make sure that we understand their psychology, what their metrics is, what their goals are, and does it align with what you have to offer. And then at the very end of the presentation, I'll give you some examples of very common loans and grants that are available for you guys as of today. Okay. Oh, before I forget. So in the headlines that Margie was talking about, the Brownfield program, it's a national program. It's very, very important that you guys take a look at it. It doesn't apply to all of us, but what it is, it's a tax credit. Applications just started about maybe, I would say, a week and a half ago. It's a recurring program, but it's very limited on annual funding. So the applications for that are going to be going through September 21st, I believe, from NJEDA's office. And the idea is that whatever the total cost of the acquisition of real estate that qualifies to this program, and if anybody's interested, I can talk about what those qualifications are. But for real estate projects, the acquisition plus the development cost, there is a 50% tax credit that can help offset the expenses of buying the building and improving your business, whatever the assets happen to be that you need to improve your business. And those tax credits are actually transferable in case that you do sell that building a little bit later on. So it's very important to know what funding options we have and make sure that we take advantage of them as quickly as possible. All right. So how to prepare. So the first step is knowing what I actually need, and I match that up with somebody on my side, somebody who's a financial advisor or your accountant, your bookkeeper, match that up with what the capacity is of your business. So if I need $100,000, a typical underwriter will say, why not 101,000 or why not 99,000? I need to make sure that I have a very thought through process of why I'm getting to that $100,000 ask, and then matching it up with how it's going to be broken up. So there's going to be a document called the use of proceeds, which we'll get to a little bit later on, but it says, this is how I'm going to be using that money. Some of it's going to be in reserve. Some of it will be general working line of capital. Some of it will be for the acquisition of these assets or for marketing or for legal, registration, stuff like that. But it has to be very clearly laid out with what I'm going to be asking for. More often than I would want to see, I work with businesses that say how much is available or what do I qualify for, and we have to kind of come back at it and reverse engineer it and say, this is actually what I need for my business to grow. And we make sure through the projections, which I have an example of in a little bit, does the business have the ability to take that and turn it into a profit at the end of the day? If it's debt, I need to make sure that all the expenses are being covered by the income, and then there's money left that's left over. If it's a grant, I need to make sure that it's meeting the requirements of the grant issuer, which is another major one that we'll get into in a little bit. So, and nice little segue, because research the lender and the grant. Every lender, every grant issuer has a different appetite. Sometimes it can say, we do, I don't know, buildings, but not gas stations, because gas stations might offer either a different industry expertise that's not available at my bank, or they might come with, with, I don't know, environmental risks that bank is not willing to take on, doesn't understand the needs, it doesn't have the talent in-house to really process the risk associated with that industry. Something else to keep in mind is on the lender side, if it is debt, this is only something they can only find out once you have conversations with that lender. But what's the general, allowances that they've given for that industry already? Because just like your personal investment portfolio, you shouldn't be too concentrated in one area. So if a bank already lent a lot of money to one particular industry or one particular region, they might want to diversify their lending and say, well, we're tapped out at the moment for this particular industry or this particular region. And even though your credit is great and your cash flow is fantastic, we're going to hold off on lending for that industry until maybe the next fiscal year. So you should do a little bit of research on the lender and grant issuer. For the most part, that last example is not something that's too common, especially with the larger banks. But if we're dealing with a local regional bank, we should be aware of what they have an appetite for and what they have an appetite for in general at that moment in time. Very important. And on the grant side, we have to find out what are the missions of that grant, what's the purpose of that grant, and can my business satisfy them? Sometimes a grant might be tied to job creation, or it might be tied to a green initiative. Can my business satisfy those requirements at this moment in time? And if there is, I have to make sure that I clearly tell that story as to what my plan of action is going to be to reach those goals. So understanding funding needs, that's what I just spoke about before. Capital structure, I'll touch on that for a moment right now. Capital structure is what combinations of money is going to be coming together to achieve whatever my goal is. One of the things that we should never do is allow all of the funds to be focused in one area of, or sources of funding to be focused coming from one area. If it's a grant, most grants will say, we will fund this program as long as you have a diversified, pool of funds, because they don't want to be known, it's bad press, as the reason why your business, why the nonprofit or whatever it is, didn't fulfill its mission because they ran out of money or they pulled their funding for whatever reason. We want to make sure that your income source and your capital structure is diversified to make sure that we have a high possibility of success and continued for that mission. So I've already spoke about the developing the strong story. And in most cases, we do have to practice a pitch. Even if it's commercial debt, and especially for a grant, oftentimes there's going to be an interview portion of the funding, depending on what we're asking for, what stage of the business you're in. But there's usually a part where the banking officer and maybe one of the key stakeholders at the bank's office, or especially the grants office, will ask you, talk to me about your business. And it's them making sure that your industry, that your opportunities, your threats, and how you're going to take advantage or hedge that risk. So there's going to be an opportunity to practice your pitch. And people who work with the SBDC, especially with the capital team, but all throughout the state, one of the things that we do is we make sure that story is almost second nature to you. So we do practice those pitches on the inside. I do have a checklist here that kind of gives you an itemized look at what's going to be needed to prepare to have that conversation. So for the most part, we're looking for a couple of things. Actually, because I'm thinking right now about something else that might be important to the story too, but I'll wait till the end. But for the most part, these are the documents that we're going to need. Anybody who is a owner of the company, typically 10% or greater, their information is going to be required. So if it's just you as the owner of the company, just your information is required. But if you have a business partner, and it does get a little bit complicated, and that number is not a law, it's a general practice. So every lender, every grant issuer will have a slightly different number, a little bit higher, a little bit lower, but just keep in the back of your mind that if anybody takes a position within my company that takes ownership of 10% or greater, their credit's going to be asked for, their personal financial statements are going to be asked for, Their resume is going to be asked for, and that might help or hurt your possibilities of getting that funding. So it's very important to understand that. A little bit summary on who the managers are and any key contractors that you have inside. For example, and I put down there for construction, but it could also apply for a couple other things as well. But the idea is who are the main players in my business model, and those are the contractors that we're looking for. We're not looking for the contractors that are a subcontractor or somebody who I don't know, by contract to clean the windows of the building, but more of the contractors that that I hired to act as a general manager or a general contractor. So on the business plan, how much of the business plan is needed for funding purposes depends on the type of funding and depends on the stage of your business, but you should always have a business plan. So a business plan, which I'll go into in a little bit more, it's the instruction manual of how you run your business. And a lot of people, depending on the stage of your business, will either say, I know it in the back of my head, but once we put it on paper, we can see it from a different perspective. And it has just a lot of value. When I present to a bank or a grant issuer, I take excerpts from that business plan, or I take versions of that business plan that are more focused to what they want to see. So then we'll create a different version, but now I have source material where I can copy and paste different sections, and then I use that for my loan package. So all these documents that we're talking about now, this is what we're using for that funding package that we're looking for. Now, credit's a very finicky one. I'm talking about, by the way, in general statements. For the first page that I have here, it's a general ask, for most cases. This is the closest to a one-size-fits-all approach. We do have on the subsequent pages information about different types of loans. I don't want to spend too much time on it, and the documentation that's required for the different types of funding, grants, whatever they happen to be. So on the credit report, for most basic lenders, 620 to 680 is a starting point to have a good conversation. But there are some cases where no credit is asked at all, especially when the majority of the decision is being based on collateral. Tax returns, very important, 2 years of your personal and 2 years of the business. And I put here, if available, because if it's a startup, obviously we don't have 2 years of the business. But if it is an existing business, we need 2 years of the business. And it's very important that for those that are startups, funding is more limited, but it doesn't mean that we're closing the door on the conversation of funding. So, but for the vast majority of loans, especially north of $50,000, if the business is not in business yet and still at that conceptual theoretical stage, we're going to be very limited with the amounts that we can get, and very limited with the options of lenders that are out there or grant issuers that are out there. However, again, there's always exceptions. Like I said in the beginning, there's never came across a situation where I couldn't get the funding. If it is conceptual, we're still planning it out. If there is significant letters of interest or there's significant assets, then we can pass that $50,000 mark. So again, everything is very bespoke to the situation that we're in. Your financial documents, your year-to-date cash flow statements, if it's a business that's already cash flow positive, year-to-date profit and loss, your balance sheet, which we'll get into again in a little moments, your pro forma, which is your projections, and 3 to 6 months of your business checking accounts. These are general asks. Depending on the type of business, depending on the type of funding, they might be additional documents that we need in the financials. For example, if your business has a strong component that is receivables, because we have contracts that we sent out, then we might need aging statements in addition to these. That says these are this is the track record of how quickly I can collect the cash. That's what an aging statement happens to be. And then legal documents, the articles of formation or incorporation, that depends on whether you are an LLC or a corporation subchapter S or C, registrations and certificates, if applicable. In some cases, they're not really needed, but sometimes I might need to show that I am a VBE, a veteran business enterprise, or SBE, a small business enterprise, in order to qualify for the funding. Business licenses, if applicable, to show that I am registered to do what I say I am doing. Sometimes we also need copies of contracts, that can show that I do have the interest, or I do have more predictable cash flow coming down the line because I have a distribution contract or I have a procurement contract. It's very, very important to show these. And if the business has renting a space that's important to the business model, a manufacturing facility or a warehouse where I need to store my inventory. Very important that for the commercial lease, even though the loan has nothing to do with the real estate itself, I need to make sure that the life of the loan does not exceed the time that's left on that commercial lease. And again, that's just from a bank protecting their position to make sure that they fund not a business that has everything that it needs in place in order to continue to operate, at least during the life of the loan or the life of the grants. Okay, so again, I can come back to this at the end. But I just want to kind of give you a little teaser that we do have a checklist here for all the different types of loans and funding that's out there, including crowdfunding, which is not a loan at all. Well, it can be sometimes, depends on what crowdfunding database we're using. Microloans, alternative loans and grants and whatnot. But these are going to be some of the documents that we'll need to start the conversation, depending on the type of funding that we're looking for. And in some cases, like I said before, if it's we have horrible credit. Oh, this is the important part that I want to mention, which ties into what we're saying right now. So for funding, we need to keep in the back of our mind the 3 C's of lending. In some cases for us now, it's for business purposes, it's the 5 C's of lending. And so if you Google them, you'll find them, but it's going to be credit, which is the history track record of how you've paid your bills. Compensation, which is showing the cash flow that is going through your hands or through the business's hands that shows I have the capacity to pay this back. The collateral, what kind of guarantee, what kind of asset can we pledge as a guarantee that we're going to be able to pay this back? And those are the 3 for all types of loans. For business loans specifically, we're going to look at 2 additional ones, which one is going to be your character that says, why are you a good fit for this business? And the last one is going to be conditions. The conditions says, this is what's going on in the world around me. Whether it's good or bad, I need to be able to highlight both. And then I need to be able to address both. If it's bad, what am I doing to hedge my risk? And if it's good, what am I doing to take advantage of it? The combination of those 5 C's of lending is what we need to be able to tell in the story or in the loan package. So going back to this, if we're weak on one of the C's of lending, we need to make sure that we make it up by providing another C in a very strong light. So if we have no credit or very weak credit, we need to make it up by either strong cash flow or strong assets. It's easier for strong assets, and that's called an asset-based loan. And in those situations, I don't need credit report. I just need to see that there's a strong piece of collateral that can be used to guarantee this loan. And that's the example. Margie, do we have any important questions on this, or should we go back to the presentation? If Margie, okay, well, I do have a hand raised, so let me. I apologize if I mispronounce your name. It's Heidelina, I believe. But let's see what the question is. Let's see. Let's see if I can find it real quickly. Let's see. I don't
Ryan,
see.
we have a couple of questions here
Okay.
for that.
Thank you. So what's the question?
So
From
one of them is this for grant funding or loans?
So I'm trying to cover all of them. So I'm trying to give you a crash course on the mentality, the psychology of getting funding. So I'm going to be covering both debt and equity, and grants. So actually all 3 topics. So hopefully that answers the question. If you guys see that there's a lot of interest in one of the topics, please let us know, and we can do an entire presentation on just one of those 3 areas. But the sources of funding are going to be debt, equity, and grants. And I'm trying to give you a crash course, a 10,000 foot overview of what's needed to encompass all 3. If there's a lot of interest in one, let us know, and we'll create the next presentation to focus on one of those. Or if you have questions on just one of the 3, at the end, I'll be able to field those questions as well.
Ryan, let me interrupt you. A lot of people are asking for the checklist. Please know that if you complete the survey, you will receive all additional resources, as well as the copy of the presentation and the checklist.
Correct. And the checklist is always provided to the clients that we're working with. So if you're interested in having someone to talk to about the checklist at the same time, register for a consultation service. Again, it's always at no cost to you guys, and there's nothing for us to sell to you guys. So, it's just nothing but added value. Have a conversation, get a copy of the checklist, and see what's the right fit for you. Okay. So what do you guys think? Should I go into the next slide?
Yep.
Yep.
Some of
Actually,
them, and I think
Hmm?
sorry, you actually answer them. Some people are asking for funding, where they can find a specific funding. And I think you already answered that. I'm sharing the link to no cost consultation in the chat. So if
Fantastic.
any person have any tailored questions, you
Fantastic.
can always request consultation.
Exactly. I appreciate that. Also, since I mentioned Heidelina's, and I have a hand up on my side, can you look for her question and see what it is, so that I can make sure that I adjust it? But at the end, I will be giving you guys very specific loans and grants that are available at the moment, so you guys can take a look at them. And I will be talking about pros and cons of each in a moment.
Yeah, I'm gonna look for that question, and then I'm gonna let you know when I found it. And Haiti, if you're here, feel free to drop it again in the Q&A box.
Yeah, I was just going to say that if she can resubmit it so we see it, because I was also looking for it and I couldn't find it.
Okay, perfect. All right, so let's go back. Let's see. All right, perfect. All right. So now we're talking about the preparation, right? That's what we just finished. Now, first one, business plans. So again, for all three, for loans, for grants, and for equity investors, we always need a business plan, because it tells a story of what we're doing. I don't know the person that I'm lending money to outside of a basic conversation that we just started to have maybe a few weeks ago or a month ago. So how can I best address how much risk is associated with me taking money out of my pocket and putting it into your pocket, assuming that I'm either the debt issuer, the grant writer, or the equity investor into your business? A lot of that comes from the story that you tell me, and it's the business plan. And I've seen most business plans that tell a good story if it's almost a sales job, but we want to tell the operation job. So my strongest piece of advice when I'm doing this while working with clients is make sure that you give information on the operations as well. It's great that the product is solving this problem, but there's usually a strong, large amount of businesses that I work with that skimp lightly over the daily operations. What's the instruction manual of how the business runs? And these are just some basic points on benefits of the business to help provide clarity, focus, guidance, also credibility, especially when you guys add sources of data to your business plan. When you say it is a $1 billion industry, that's fine, but let me see what percentage of that $1 billion industry is your percentage. If I'm opening up a pizzeria and I say it's a $1 billion industry, that sounds nice, but if I am only a one shop operation on 123 Main Street in whatever town in New Jersey, I don't have access to the whole $1 billion market. What I do have access to is a drive time map or a heat map of maybe 30 minutes in any direction from my business. That's the majority of my customers. Now I can take data from what the economics is of that community, and now I can say I have a $2 million market. Because that's how much people spent in pizza or in restaurants in the last year, and those are data points that we can get. Anyway, so that's very important. And then the last one, the most important one in my opinion, is it serves as the directions of how to run your business, and that makes me feel more comfortable as all three, as the debt issuer, as the grant issuer, or as the equity issuer. All right, so the components of the business plan are as follows. There's a ton of different templates out there. We have templates that we work with on the SBDC. And for the most part, the ones that we work with have proven the test of time that it's what most lenders, grant issuers, equity investors do want to see. So the executive summary is the first section that we see, but I oftentimes will see that as the most developed section, or the first section that people write, but it summarizes the entire business plan. We write that at the very end, after we have the entire business plan. We summarize everything into one page, take a little bit of each section, give it a couple of sentences, put it on one page, and that serves as an overview. The purpose of the summary is so that the person who makes the decision whether to put funding in your hands has an appetite for what you do. Because it might be that you're in the wrong industry for them. I know a lot about healthcare lending, but I know very little about manufacturing or international trade. So I want to make sure that we're matching, expertise and we're as synergistic as possible. So, company description, very quickly, it could be, one page, or a few paragraphs, depends on which version of a business plan we're using, but it should be describing the multiple sections that we're looking at here. Owners, entity type, a little bit of the history of the company, what brought you to that position, little things like that. So again, the business plan templates that we have really do a good job at kind of guiding you and making this very easy, almost kind of filling the blank. Market analysis. This is the one where I've mentioned before, where sometimes we need a little bit of massaging, when we're saying how much of that data that we're pulling is for your industry or has your reach or within your capacity. But we need to make sure that we source all that data that we're looking at. So the last section of the business plan, which is the last bullet point, the appendix, is where we're going to put all the links or all the reports that we're using as source material for our market analysis. Quick little description of the product or the service. Very important. The engine of the whole operation is how am I going to let people know that I exist? How am I going to put products in our hands? What's our cost for client acquisition? How do our clients repeat business? Those type of things. It's all in the marketing and sales. And regardless of how great a product is, if it's out of sight, it's out of mind. That's ultimately the truth. So the marketing and sales is the engine of all our business models. And the financial projections, which I'll show you in maybe a slide or two. I can't remember exactly what some of those projections will look like. And what's very, very important, this is perhaps the most important one here on this, especially past or in a world that's post-pandemic, is what is your contingency plan? As a result of a lot of businesses not being prepared, once the pandemic came around, a lot of businesses closed up shop. A lot of businesses, needed money as a bailout to save themselves, because we weren't focused on an insurance policy. We weren't focused on and when I mean insurance policy, I don't mean the actual insurance company. I mean our own plan of attack in case things go south. So how quickly can our business pivot? How diversified is our income? Are we focused on one client, one industry? What other versions of our business can we quickly adapt to in case something bad happens? So that contingency plan is a part that's mostly focused in recent years, in the past 2 or 3 years, than it has been in the past. It's always been there, but my personal experience, I've seen more underwriters really look at that and dissect that section a bit more than they have in the past. It's very important for us to give that a little bit of thought. So step 2 is the financial story. So we just told the business story. Now we're going to tell the financial story again.
Ryan, one quick question. Let me interrupt you.
Please.
Before you get into financials,
Yeah.
Brittany asks, does being denied for a loan look bad when you ask for another lender?
That's a great question, because there's no clear answer. It's almost a little bit of a double-edged sword. So in one aspect, they only really see the credit hit. They don't really see that there was an actual application and that it was denied. I oftentimes work with a lot of entrepreneurs that were denied a loan. And oftentimes, most of those actually come from the bank. I'll get a bank ABC that calls me and says, one of the clients just got denied for a loan. Can you help them? Sometimes it's just repackaging the information in a different way, or including new information that can show the business from a different perspective. And sometimes I can take that same application right back to the bank that denied them, and now they get approved because it was prepared correctly. So from one side, when I said it's a double-edged sword, from one side, they don't see the business application. All they see is a credit hit on as an inquiry. Depending on how often we are inquiring for a loan, depends on how many inquiries we have. Now, it's very important that we understand what the rules are from the way that the credit bureaus manage their scores. There is a law, and I don't want to state the number of days because it goes up and down on a little bit, but we are allowed to shop around. We do have a consumer right to shop for the best deal. So we can have our credit pulled within a certain time frame, let's say 30 days as an example, without being penalized for my credit. But if I continue to apply for loans past that period of time, there is going to be an adjustment to my score, a momentary adjustment, where it falls a little bit because I'm excessively looking for money in different places. So the short answer, or the short-term answer is no, it does not affect you. But if it passes that amount of time, and I see that you've been applying to 20 different banks and you have 20 different inquiries and it's passed, and it's been happening for the last several months, then yes, your score will be taking a momentary hit. And depending on what your score started off in the very beginning, you might now no longer qualify for the loan. Because if you were just shy of 680, and now you're or just above 680, and now you're just shy of it, you might not qualify for that loan. So it's always best to talk to an accountant, a financial advisor like us here at the SBDC, so we don't waste too much time knocking on doors. I don't allow anybody to have their credit run without us looking at it and knowing what the appetite is of the lender and what the likelihood is of that loan being funded. Hopefully that answers the question. All right. So continuing on with the financials. So the first part, like I mentioned before, is that use of proceeds. How much money are we asking for? And again, I know I've said before, but just as a reminder, this is for all sources of funding. This is for debt, equity, and grants. So it's what am I asking for and how much? That's that use of proceeds. It's a simple itemized, spreadsheet that says this is how we plan on using all the money. $10,000 here, $1,000 here, $500 here, whatever the number happens to be. But it talks about how we're allocating that money. What are we doing to monitor the money is going to be the other financial statements that we're looking at, which is including the forecast and the pro forma. And then how are we measuring our impact and our decisions, and then we make readjustments. So the financial statements that we should be looking at in the very beginning, the basic financial statements are always these three. This is always the starting ground for the financial statement. For the feasibility and the capacity of the business. So we start off with the balance sheet, and we look at the income statements, and we also look at the cash flow statements. PFS at the bottom is the personal financial statements, and again, depending on the exact appetite of the funding source and how much funding we're asking for, will determine whether we're going to need all of these or just one of these or any of these. But for the vast majority, the one size fits all approach, these are the basic financial statements that we start off with. And I'll go into detail about what each of these is in a moment. So the balance sheet, here's the definition. I'll read it briefly, and then I'll give you a quick overview on what it is in my own words. But a balance sheet is a financial statement that provides a snapshot of the company's financial position at a very specific moment in time. That's the key part there. I should have put that in bold. It lists the company's assets, which is what it owns, the liabilities, which is what it owes, and the equity, which is what the owners put into the business themselves over a period of time, but it's taking a quick little snapshot. So the way I like to describe this is almost like a picture. So if I were to walk into a room and I say freeze and I take a snapshot, right now I see that this dollar's over here, this dollar's over here. Actually, my hands are off camera, but the idea is right now, everybody freeze. Where's all the money at? I have $1,000 in my checking account. Right now, Bank ABC, I owe them $1,000. So I have liability on one side for $1,000. I have assets on the other side for $1,000. That's the general idea. Everybody freeze. And this is a quick little snapshot of where my money is right now. Now, if I take a balance statement, picture in the morning and in the afternoon, and then in the evening again, it will look slightly different because throughout the day, I might have paid a bill or I might have gotten paid from a customer. So that balance sheet is very, very specific to a very exact moment in time. Ideally, we just look at them throughout, as like let's say the first of that month, we'll take a quick little balance statement and then we send that to the decision maker. Now, this is what a balance sheet should look like. If you guys are working on your own financials or you guys have an accountant that you guys work with, this is what it should look like. Basically, it's three basic sections. We got the assets on the left, liabilities on the right, obviously, and your equity on the bottom. But very important to note, we have current assets up on top and long-term assets on the bottom. Same thing with current liabilities and long-term liabilities. What the difference is between current and long-term is how quickly something can turn into cash. So a current assets I can either use it as cash immediately or turn it into cash within the next 12 months. Long-term is it turns into cash over a long period of time, past the 12 months. Same thing with the liabilities, and then stockholders' equity is just the money that I've earned or invested into the company. So that's the basic makeout of a balance sheet, and very, very important. All the numbers have to balance, which is why it's called the balance sheet. So the amount of money that I have on one side, just like the formula from before, the amount of liabilities plus the equities has to equal what all my assets are. And you see over here, 770, 770. If there's oftentimes we're working on financials, these numbers don't add up. That means that our bookkeeping wasn't done correctly, or there was a data entry, or maybe even just a miscalculation somewhere. But we can fix those. Income statements. So income statement, also called a P&L, profit and loss, is a financial statement that shows a company's revenue, expenses, and profit over a specific period of time, typically over a month or a year. The income statement is used to determine the company's profitability and financial performance. So this one is more like, if the other one was a picture, this one is a film. This one's a movie. It's a short little video that shows what's happening throughout throughout that period of time. I can say for the last, year to date, from January 1st until today, this is how much money has come into and out of the company from the perspective of profitability. That's the key thing here, because it's very very easy to confuse it with a cash flow statement, which I'll go into next in a moment. But this is what an income statement looks like. So very important. All our revenues up on top, our gross profit, and all our operating expenses down below. So in here, again, it's looking at the cash flow from the perspective of profitability. It doesn't take into account all forms of income, which is what the next one's going to be. So the cash flow statements. So a cash flow statement is a financial statement that shows companies' cash flows, inflows and outflows. All money comes in, all the money that goes out over a specific period of time, typically over a month or a year. And the cash flow statement is used to understand the company's liquidity and financial flexibility, which are important indicators of the financial health of a company. And this is very similar to the other video, but imagine if we're looking at, using the analogies of movies and pictures or films and pictures. This is just a second camera filming the same exact birthday party, let's say, from a different angle, from a different perspective. And it's just showing, more important, like I said before, the liquidity and the financial flexibility. So this is an example of what the cash flow should look like. Some quick little examples of things that might appear on one that might not appear on the other could be things like depreciation or taxes, or interest that was paid. So those are things that would appear on one side versus the other side. I don't want to spend too much time on this because there's some good stuff that I want to go to, but I am giving it a little bit of time because, again, like I said, in the last 20 years or so, I've seen most of the applications get caught up because, like I mentioned, the documentation, the preparation wasn't done correctly. And the majority of those times, it's because of the financials. It's not justifying the ask, or it's not showing a business that makes the underwriter feel safe, all warm and fuzzy on the inside of actually putting this money out into your hands. So the projections. So this is a copy of a template that we work on, but I'll actually open it in a second. Let me read through the questions, but the projections, this is important for everything. So this is going to be for a business that is at the conceptual stage or a business that has 20 years of experience, doesn't matter. We want to see, what does the next 12 months look like? Very important that projections are broken up on a month-to-month basis for the next 12 months. Anything that's past that, it gets more speculative the further out into the future it goes. So I see people that have 5-year projections and it says, oh, we're going to make so many millions of dollars in the next, so many years. That becomes, again, like I said, very speculative because nobody knows what's going to happen in the future. And nobody's business plan in 2018 was there a line item for the pandemic. So we don't know what happens tomorrow. So what we can do is, the closer it is, just like weather report, the closer it is to today, the more accurate we can predict, an outcome. So for the next 12 months, put it down into a month-to-month basis, which I'll show you what that looks like in a moment. And then maybe if you want to, you can summarize and have an abridged version for year 2 and year 3, but I wouldn't really put much effort in going anything past that because it's not giving that much weight anyway. We have to make sure that we have very clear questions that are being answered because of the projections that say, some of these questions over here, what's the production capacity? What are your sales goals? or during that interview, like I mentioned before, people will ask, or underwriters will ask, how much are you going to spend, as an example, in payroll during November, if November happens to be your peak month or your slow month. But these are things that are very important to understand and be able to address quickly, because it says your business inside and out. Again, whether I'm the grant issuer or the debt issuer or the equity issuer, I feel more comfortable when you really understand your business and your business fund. You can answer these questions quickly. So let's go into a quick little example of what this looks like. So I modified a template that we work with just for the purpose of this presentation. And this one, as you see, as it's loading up, I have a lot of different tabs on the bottom. They're all interlinked. You don't have to use this template. There are a ton of great templates out there. And depending on what the ask is, will depend on how much detail you need to provide in that projection. But I think this is a great starting point for you guys, for yourselves, regardless if I'm going to ask for money or not, because it gives me better control over my information. The higher the quality of my data, the higher the quality of my decision-making becomes. And that's where it becomes very important. So this is going to be similar to that use of proceeds that I mentioned before. That use of proceeds is how much money am I asking for, and where's that money coming from? So in this example, it could come from a few different sources, like I mentioned, but I'll show you those in a moment. But my fixed assets, this is a quick little example of how much money I might spend on improving the space that I'm in, how much I might need for equipment, how much I might need for furniture, and my total ask on the fixed asset side. But I also need more money for our operations, so how much money for insurance purposes, for legal purposes, for different things that I might need as the operating expenses. So it says here that the total request is going to be about $50,000. I should probably total required funds. Okay, good. I thought I said something else there, but $53,000 is what I will need to make this project a reality. Now on the bottom, I'm going to put down, where does that money come from? I'm going to take $15,000 of my own money and I'm going to put it aside as my reserves. So I'm telling whoever invests into me that $15,000 of my own money is on the side as my reserve money. But I still need a couple of additional dollars. So towards the loan, I can put down, if it was a loan, $5,000 of my own money, and I can customize these to say anything I want on the side. I can put down grants, I can put down equity investor, whatever. But owner's equity, $5,000, that makes up about 9.29% of the funds. In most cases, this is an example, I did this on purpose to show that this would not work. In most cases, I need to be able to show that I can put at least 10% of the money out of my own pocket towards this project. Now, there are some cases, like I mentioned, where you can get, if it's a small microloan, perhaps 100% financing, but I need to show that you have some skin in the game and show me that you have reserves on your own side and we'll fund the rest. But for most cases, most loans, you do need to put a down payment towards your own project. So we'll say, hey, this is what the project costs. I'm going to put $5,000 towards this project, but I need to get the rest from a commercial loan, as an example, of $44,000. And I could put down the interest, and then it starts to calculate what those interest payments are going to be a little bit later on. So let's jump around to some of the other more important tabs over here. Payroll, it says, this is how much I'm going to be spending on payroll. And we take everything into consideration, how much money is going to be paid and held in taxes, and I put all the updates here. And this is what the numbers are looking like throughout the month. And I can increase these during peak season or slow seasons, especially if we're a seasonal business. And then see, year one, it's broken up on month by month basis. For years 1 to 3, it's broken up and consolidated into 1 year. Now the sales forecast shows us what are the sales that are going to be happening from what products that we have on a month-by-month basis. So this one is going to be all the different products that we have, and I can put down whatever name of a product I want here. Whatchamacallit 1, whatchamacallit 2, thingamajig 1, thingamajig 2, and it'll say this is how many sales of those we're going to experience each month for the first year. And again, we summarize it. And as you see, it goes into lots of different details, but this is what you should be providing, again, not only to the decision maker, but more importantly to yourselves, because it shows, hey, this is I have good control of my business. Okay, so let me get out of this real quickly. I'm going to speed along a little bit just because I want to make sure that we have enough time to cover everything and the questions, because we're almost at the end. So things to keep in mind for when a decision maker is looking at the viability of putting money into your hands, depending on who's looking at it, they will determine what the feasibility is based on their analysis. And when they're doing that analysis, these are the most common ratios that they're going to calculate based on your financials. Again, whether it's a grant, whether it's equity, whether it's a debt, they're going to be looking at some of these items. Every lender, every issuer has a different appetite. And again, I'm trying to create a one-size-fits-all webinar, I guess, so to speak, for you guys. The most common one is number 7. Number 7, which is the debt service coverage ratio, says, show me that you can pay all your bills and still have money left over. That's honestly what that means. And the easiest way to calculate it is whatever your expenses are, you should be making 125% of that every month. So the debt service coverage ratio that most banks are going to be looking at, or most investors are going to be looking at, is a DSCR of what's called 1.25 or greater. That's the traditional approach, especially in the world of lending. That just says, I can cover all my expenses and I'm still making a little bit of money. After we do the analysis on the pro forma and we see that we're still at 125% or greater, it says, hey, we have something that works here. And then of course, they'll look at some of the other ratios to make sure that from different angles, you're still in position. All investors, all lenders, all grant issuers wants to make sure that the model keeps on working and continuing to do its mission. So we just want to make sure that you are in a position of continuing to do whatever it is that you guys are going to be doing. Okay, so the methodology of funding. So how do we know what funding to ask for? Do I ask for this dollar? Do I ask for those dollars? So we're going to assess the needs of what we need. We can have that conversation internally. We look at the funding options. We'll talk about, hey, we can get the money from here, we can get the money from here, and we can get the money from here. But these are the price tags of all the different sources of funding. And we need to make sure that the price tag and the type of funding that it is matches your use. And here's a quick little example. Remember, this is one of the really important ones, I guess, important statements throughout the webinar. Long-term debt has to match to a long-term asset. Short-term debt has to match to a short-term asset. There are some debts that are considered long-term and short-term. For example, a credit card is short-term debt. So I shouldn't have something where I extracted value only during month 1, but I'm making payments for a long period of time. That's a quick little easy example of how to match long-term debts. A mortgage is a long-term debt, so it matches a long-term asset because I can continue to extract value for the next so many years, 10, 20, 30 years. And then we'll evaluate eligibility, and we'll consider the risks and costs of each. Let's see, go to the next one. Additional ones, match the funding option to the business stage. If we're asking for, I had a client that was asking for a couple $1 million to do a project, but they weren't at that stage where they can justify it. I said, I'll get you the money, but give me a year or 2. Let's work on stage 1, stage 2 first, and then we'll talk about stage 3 money. So understanding that the money is always going to be available, but maybe not at the right time that you're looking for. Obviously, we work with work always with a professional. Evaluate trade-offs. Which is sometimes we'll take a different type of money in order to achieve the goal that we want to, which is bigger money a little bit later on. And develop our funding strategy. Like I said, it could be tax credits, it could be debt combined with a grant, so there's a lot of different ways that we can get to where we want to get to. So the types of funding options, like I mentioned before, we have debt, we have equity, we have grants, crowdfunding, and a lot of us in the very beginning bootstrap our own businesses and we take money from our own pockets and invest it into the business. I'm just kind of breezing over these because I want to get to the Q&A part. And if you guys have questions, you want me to go back, please, by all means. I'm not in a rush, so we can go back to these questions. The different types of loans that exist out there. Term loans, which says this loan is going to be paid back over this many years, 7 years, 10 years, 20 years, 30 years. They can be secured or unsecured, which means there is a piece of equipment that we're using as guarantee, or a piece of real estate we're using as a guarantee that's secured or unsecured, which says I'm just going to get a working line of capital or a term loan for my business that is pledged against the enterprise value or against my cash flow. That's an example of the secured version is the commercial loan. A revolver or a line of credit, same thing. The purpose of this one is to satisfy a cash flow shortfall. I have a contract. I'm not going to get paid for 45 days, but I have expenses every week until then. So let me get a line of credit so I can satisfy that contract. That's how a line of credit should be properly used. SBA loans, the idea is that the SBA does not lend money to you directly during normal times of business. What they do is that they work with the bank to help guarantee. They almost act like a co-signer to make the bank feel more comfortable with issuing you the money, because they're going to guarantee the majority of that back to the bank in case there's a default. Equipment loans just give you more tailored solutions. If you buy, different equipment has different lifespans. So if my equipment lasts me 5 years, they'll give me a 5-year loan. If my equipment can last 15 years, they'll give me a 15-year loan. Again, matching the right money with the right use. Mezzanine or asset-based lending or hard money loans, all the same thing. The idea is slight variations, but the idea is I need money quickly. I don't have credit, or I just need money quickly, even though I do have credit. Someone can take a look at what asset you are pledging, and they'll give you money within a couple of days. And usually most of those tend to be larger loans, $500,000 and or $1 million and north. But they are available. It's good to know. Cash advances, they just take a look at your checking account. What are the average deposits? And they'll lend you money based on that. AR receiving or factoring, warehouse lines. They're looking at your receivables and they'll lend you money against that. Microloans, like I said before, $50,000 and less, those are microloans. And that's basically mainly based on the quality of the story that we're telling, the business plan and whatnot. And in some cases, personal loans might be something that we could talk about as well. So on the equity side, we have common loans, preferred stocks. For most cases, most of the small businesses, we don't really get into equity. Equity tends to be the most expensive form of raising money because you're giving up a percentage of the business. But for some people, it does make a lot of sense, especially if we have a lot of scalability with our business and we have a grand view. I'd rather have 10% of Amazon than 100% of a local, a local gas station, as an example. So in some cases, it does make sense to take, stocks or give out equity. I can speak to all of these at great length. So if you guys have a question about, convertible stock or convertible debt or, whatever that happens to be, we can go back to it and revisit it. But just keep in mind that this is an option for us as well. Grants, things to know. Most people love free money. I love free money, but grants do come with a set of unique obstacles. Primarily is that it's very competitive. Grants are usually not, evergreen, so they are only lasting as long as the funding from whatever the grant source happens to be, able to fund that project. And there's a lot of time that goes involved into preparing for the grant. So it's not a very simple application where, I fill out like a one-page application and then get the money in the next day or two. And I know you guys know most of that. I'm just, oversimplifying it. And then there's also a lot of things that come along with the grant. In most grants, I have to do ongoing reports. This bullet point over here, grant reporting and accountability. So I might have to show how the money is being used after I receive it. And in some grants, they're reimbursement grants, which means I have to put the money up front and then I get reimbursed. So every grant works a little bit different. There are, I like grants.com. Grants.gov, which I think I mentioned. Yep. And the next slide, grants.gov, that is all the government issued grants. These are very specific examples of grants that are very popular right now in New Jersey. I know in the very beginning, we mentioned the Brownfield Redevelopment Incentive that just got launched a few weeks ago for this year, and it's going to close on December 31st. But NJEDA also has a lease assistance grants, which means that they're going to pay a percentage of your lease, again, as long as it qualifies for the next couple of years. Small business improvement grants, where they'll fund you, I believe they reimburse you 50% of the equipment that you purchase for your business. Small business lease grants is another one from them. I have links to all of these, so we can take a look at all of these if you guys wish. Again, we'll talk about them in greater detail. I just really want to get to the Q&A. This is a nice this is a nice unique one that most people don't know about. For those of us that are developing new technology at a federal level, in partnership with a lot of different government agencies, Department of Agriculture, Department of Defense, they will fund a grant that will help you develop, do the R&D, the research and development, and the commercialization of a business. And the size of the grant is sometimes a couple $1 million. So you get a couple $1 million in grant funding that you don't have to pay back. That's the SBIR program, STTR. They're both very similar. and being sourced from the same place. We have a specialized team here at the SBDC that can help you guide you through this process. And like I said before, the funding is pretty significant, so it is worth your time if it's something that is for you guys. All right. This is one from the USEDA for those of us in more rural communities, and the place to go to, and which I can show you how it works, is grants.gov, and we can then recategorize the filter by showing me all the ones that are for businesses, as long as we are for business entity, which I assume most of us here are, because most grants happen to be for nonprofits, but there are several that are for businesses. Other popular grants here, Google has one that's an ad grant for those businesses that qualify. They will fund some of your grant dollars. Some of your advertisement dollars for the next year. Federal Express has a nice, loan a grant that goes on, on a yearly basis. Same thing with Amazon. I've personally did one with Tory Burch recently. This is, these are some of the ongoing ones. Something to keep in mind is the business plan competition. This is another great one. Even for those businesses that are already cash flowing, you can join a business plan competition. I sit on the panel where I'm a judge of 2 different business plan competitions where we award $50,000, or actually the other one $100,000 to businesses that pass a lot of the questions. This is just linking to an article that shows you what the business plan competitions are this year. Make sure that it fits the mission of what your company is, that there's a good fit. And it's a competitive environment. It's very similar to like American Idol or one of these competition shows where we're just asking questions from the judge's perspective, and based on how you answer those questions, we assign points and scores to you. So a recap, and this I think is the last one of what we need to do in order to get our funding is know what we're asking for and know the business. And then match that with the source of funding that we're going after. Have that conversation with somebody like myself, who is a business advisor, who can say, these are the different options of funding you have. What direction do you want to go into? And then you guys are the boss, and then we'll start to create a plan around the version of the funding source that you guys want to. So now that we did the workshop, we can start some of the questions. It says here, what's next? What do? We can seek out resources from us and other courses online, tap into the experience of any consultant that's here. Obviously, you're going to connect with one of us, and then we make the plan point from there. So with that said, I believe that's the last slide. Guys, ask me questions. Where can I go back and shine a little bit more light onto this? And I apologize that I spoke fast towards the end. I just saw the time, and I want to make sure that I got through all the slides before answering the questions.
Thank you, Ryan, so much for your presentation. Please, everyone, if you want a copy of all the resources and of the presentation, make sure you submit your 3-minute survey, and we will send you a copy of everything that he just presented you. With that being said, we have a bunch of questions. Are you ready?
A bunch of questions. Awesome.
All right. So I have Hector Velasquez. He says, I have an SBA loan, 2 years, $350K. Can I qualify for a 504 loan?
Yes. So questions, absolutely. Not only can you qualify for the 504 loan, you could also, without the 504, you can just refinance that SBA loan if the rates happen to be more favorable today. SBA does have a policy that allows you just to refinance that loan with SBA if the terms and conditions are more advantageous to you at this moment. So when we do the 504 loan, most likely we're going to wrap up and consolidate whatever you have with the 7A. So it's not going to be 2 different loans. The 504 is going to take on whatever the 7A is, because there's going to be new liens that have to be put onto on any assets that the business might have. But the answer is absolutely, and have that conversation with an advisor whenever you can, and take advantage of whatever opportunities in front of you.
All right, we have another question by Jade Weber. She wants to know if the business plan same as the pitch deck or media kit.
So the so sort of the pitch deck is excerpts from your business plan. So it's a business plan told for a very specific purpose. You know, for example, I know that I'm going to be in a business plan competition, like I just mentioned, or if it's going to be in front of certain, you know, lenders or investors. I use a pitch deck, which is just taking the sections that audience wants to really hear. I don't need to include anything on, you know, maybe, you know, my internal operations on my pitch deck. So the pitch deck, we're just going to go copy and paste things from my business plan and put it there, but they are two different documents. A common mistake that I've seen in the past, not super common, but common, is that I get a pitch deck in place of a business plan, and that's not good. You know, a business plan has to exist first, and then I can use that to create my pitch deck.
Thank you so much, Ryan. We have another question from Queen Davis. How is down payment documented by the lenders normally?
Okay. Well, the down payment is going to be documented there. I think you might be asking a question from, well, I'll answer it from two perspectives. One is what's called seasoning, which is, where's that money coming from your down payment? Did it just appear? So in most cases, they want to see a couple of months of your bank records to see that the money has been in your possession for so many months before using it for your down payment. That's the first one. That's from a paper trail perspective or history perspective. Where did the money come from? The second part is documenting it going forward, is showing me that the money is not going to be given to the bank that the down payment is. The bank says, show me the project cost in total, you know, and they'll verify it, and then they'll say, all right, well, we'll give you 80% of that project cost or 90% of that project cost. So it's up to you to take your money that you're saying that you're going to use as the down payment and use it towards the acquisition or the project. If it's an acquisition of, let's say, real estate, then we can get letters from the seller's attorney that the money was given to them and put into an escrow account, you know, or same thing with for equipment. But the bank will fund what's called LTV, loan to value, they feel comfortable with, at 90 or 80% of the loan, and then the other 10 or 20% comes from you. So I hope I answered the question.
All right, we have a question that is anonymous. It says, if buying a business that has an EIDL loan, does that loan need to be paid off, or can it be assumed by the acquirer?
That's a difficult question to answer. So most loans, when you buy a business, if I'm assuming that the business is being sold, is that how the question is structured? Can you read the question one more time, the last part?
Yes, hold on, I'm switching screen.
Okay, well, I'll speak in a little bit just in case.
So here it is. It says, if buying a business that has an EIDL loan, does that loan need to be paid off, or can it be assumed by the acquirer?
Okay, so when you're buying or selling a business, you buy all the good and all the bad. Typically, you buy the debt. However, depending on how what entity structure the business chose, and what stage of the business the business is in, some of those debts are not assumable, which means they're tied to the person. So in most cases, if it's an LLC as an example, the business and the person are very tied together legally, you know, and financially. So all the loans that exist are existing under the personal guarantee of the individual. So that has to be paid off by the person first. It's very hard to give a one blanket statement that applies to everything, just because every business has so many unique variables and components to it. And I can be very creative with how I structure certain loans. But for the most part, the answer is those loans stay with the person, and they have to be paid off by the person before you acquire them. The more established businesses, you are buying the debt as well. You are buying the liabilities as well. So so I hope that answers the question. The proper way to address it is work with a consultant. We'll look at the language in the documentation and see if the loans are even assumable, because the bank or the issuer might have language there that says it can't be done or it can't be done.
All right, so we have time for one more question. Are you ready, Ryan?
So which one more?
right? What do you say to the lender if your business is in a loss of 10,000 due to needing of a marketing strategy?
Due to
Ooh.
needing a marketing strategy. Ooh, that would be a difficult one to justify, because the marketing strategy is something that the leadership of the business could get creative with and try to come up with a strategy that's either low cost or no cost, which they do exist. One of my favorite books that I read, that I've read, is Marketing on a Shoestring Budget. So there's always ways to find creative ways. It's just a hard excuse to use. What I might be able to do is come up with another reason as to why I have a cash shortfall, and then find another reason to justify that that shortfall is no longer going to be happening going forward. If I have reserves in my account, I could be able to create a loan package that says, I have this new approach or a new client coming in, and I will be cash flow positive in the next, 10 months or 6 months, whatever, the break-even point happens to be, as long as I can do this, whatever this happens to be, But for the purposes of funding, if the business has a negative cash flow, you're limited with the options that you have. Most likely, these are going to be loans that you guys can look up, CDCs, Community Development Corporations, and they are making their decisions mostly on a business story, but they always look at, everybody always likes to look at cash flow and what the numbers are. But it might be easier to convince a CDC to give me additional funding than it would be a traditional lender. Another option that I would look at too are what grants are out there that are small micro grants that can help me with funding for my marketing or those business plan competitions. Because in all those cases, that question doesn't have to be answered.
All right, thank you so much, Ryan, for your time. I want to remind everyone, thank you so much for your participation. Please make sure you complete the 3-minute survey so Ryan can send you the entire deck along with additional links and the checklist for all of you that ask for that information. Please know that next week I will actually be speaking about marketing strategies. Well, taking that back to that question that you mentioned, if you want to learn how to use artificial intelligence to do your marketing strategy and to apply for your business, make sure you scan the code and register for next week. I will be speaking. It will be an interactive workshop, so it wouldn't be so much of a presentation. It will be more, you tell me the problem, I'll give you the solution, and it will be very, very exciting. So make sure you scan the QR code and register for next week.
I'll be there. I'll be asking you really hard questions.
Great. I'll be ready for you, Ryan.
Awesome. And guys, if remember, if there's a section of the presentation today that you guys want to go back and revisit, just let us know. Say, hey, can you guys do a whole presentation just on that one section, whatever that one section happens to be, or if you would want just a Q&A session, I think that might be a good idea. Just, ask a lender a question, and we can have a presentation just on that. That might be a nice, we could probably have a couple panels, a couple of lenders up here, a couple of investors, and then asking them questions. But hopefully I answered some questions for you guys. I made it a little bit easier to understand how to prepare that. And we'll go forward from there.
Thank you so much once again, Ryan, for your presentation. Please know that the NJSBDC has helped over 15,000 plus small businesses to grow. We provide no cost small business consulting. We provide training and events at no cost. And we are here to provide you with small business resources to help your business grow and thrive. Make sure you scan the QR code to stay tuned to what's next. Thank you so much. Also, one more thing, please visit our website. We have additional resources and we have webinars on demand. Thank you so much. And I hope you have a wonderful day. Thank you for all for joining us.
Go make lots of money, guys.